I want to thank everybody for dialing in here for our call on Lulu. We did add this to our best ideas list about a week and a half ago, and I want to just outline a few of the key reasons as to why. This is a sentiment monitor. This is something you've seen in the past from us. If you look at that blue line there, it's basically a quantitative score that sums up the sell side ratings. It assigns a quantitative score to each rating, and also the buy side short interest. And you can see that drop down there recently. It puts it into, I'll call it no man's land, but it's never been that bearish, which ultimately is actually quite bullish. On the flip side of that, if it were all the way up top there and it pierced that red dotted line way up top, that would actually be an incredibly bearish view. I think everybody knows no one likes this stock right now. I kind of characterized it as that Chip is tired of his handcuffs. If you take a look at this whole quote, which I won't read, I'll just read that part, which is in red. Now we have a forever non-compete clause as long as we own so much of the company. So it's tough for us. I never recognized this would happen when I went public. So I think that it's a nuance here, but when you juxtapose that with what he's doing, hiring Goldman Sachs in order to unlock value, something's going on here, and I don't think he will own his stock in a 6-month time period. Here's Chip's ownership history, Chip Wilson. So he used to own the entire company outright back in '98. Now he's at about 27.7. And that's been coming down steadily every single year. Now, one of the key mistakes that he made, so all through this time period, he was still chairman of the board. He's not chairman of the board anymore. That's not just like a fluff title. There's a lot of privileges that come along with being chairman of the board at that company that he put into place, that he walked away from back in the tail end of last year. And it's something that it will flat out come back to haunt him. There's no question about it in my mind. Lastly, on the acquisition side, here's just the accretion. So there was leverage. If you take a look at the analysis on the left-hand side, after-tax earnings accretion at a $40 deal, a $50 deal, 60, 70, you can see that even at a $70 price, you get Nike, LVMH, and fast retailing, it would still be accretive. And even the others, with the exception of Adidas at $70, it'd be 9%. It'd be a hit to them at 9%. They've done that before, at least 2 or 3 times. So there's really no stopping them in that regard. So this whole field is wide open. Again, my bet is on either the French or the Germans or the Japanese, and not anybody here in the States.